Have you ever considered what influences a company's decision on its capital structure? It's an intriguing question, isn't it? Well, let me break it down for you. Capital structure refers to the mix of a company's long-term debt, specific short-term debt, common equity, and preferred equity. It's essentially how a firm finances its overall operations and growth. Now, why is this important? Picture this: a company's capital structure is a bit like the foundation of a building. It's what supports the business, allowing it to stand tall, weather storms, and grow. But just like a building's foundation, the right mix of debt and equity is crucial for the company's stability and success. Understanding the factors that influence capital structure is akin to understanding the blueprints of a building. It's fascinating, right? Now that we've set the stage, let's dive into the factors affecting capital structure. The first factor we need to consider is business risk. Now, what exactly is business risk? In the simplest terms, it's the potential for a company's operations to result in a financial loss. This could stem from a variety of factors: a sudden shift in market trends, a new competitor entering the scene, or even a global pandemic. The point is, business risk is inherent in every venture, and it can significantly influence a company's capital structure. You're probably wondering, how does business risk affect the capital structure? Well, let's break it down. In essence, the higher the business risk, the less likely a company is to take on debt. Why, you ask? Because companies with high business risk are already walking a tightrope, and adding debt to the mix would be like adding a blindfold. It simply amplifies the risk. Think of it this way: if a company is grappling with high business risk, it means their earnings are unpredictable. Now, if they take on a lot of debt, they're committing to fixed interest payments. If their earnings take a nosedive, they could find themselves unable to meet these obligations. And that, my friends, is a recipe for financial disaster. On the other hand, companies with low business risk have more predictable earnings. They can afford to take on more debt because they're confident they'll be able to meet their financial obligations. These companies often use debt as a lever to amplify their returns. But remember, the key here is balance. Too much debt can still be a problem, even for companies with low business risk. So, to sum it up, business risk and debt are inversely related. The higher the business risk, the less debt a company tends to have, and vice versa. This relationship plays a crucial role in determining a company's capital structure. It's a delicate balancing act, where companies must weigh the risks and rewards of debt against their ability to weather financial storms. So, high business risk equals less debt. Remember that. The next factor that plays a crucial role in capital structure is the company's growth rate. Just as a tree grows by adding rings, a company expands by adding assets, products, or even other companies. And just as the tree needs water and sunlight to grow, a company needs capital. A company's growth rate can greatly influence its capital structure, the mix of debt and equity it uses to finance that growth. High-growth companies, those expanding rapidly in their industry sectors, typically have more equity financing in their capital structure. Why is that? Well, let's think about it. Equity financing, or selling shares of stock, can be an attractive option for these companies because it doesn't require fixed payments. Unlike debt, where you have to pay back your creditors on a schedule, with equity, you have more flexibility. You see, high-growth companies often pour every penny they have back into the business to fuel that growth. They may not have the steady cash flows needed to make regular debt payments, so they lean more towards equity financing. But there's a trade-off. When a company issues more shares, the owners are effectively diluting their ownership. They're sharing more of the profits with a larger group of shareholders. Sometimes, though, that's a price worth paying for the capital needed to keep the growth engine humming. On the other hand, companies with slower growth rates often rely more on debt financing. They have more predictable and steady cash flows, which makes it easier to make regular debt payments. And since debt is often cheaper than equity, it can be a cost-effective way to finance growth. So in essence, a company's growth rate can be a significant determinant of its capital structure. It influences whether a company leans more towards debt or equity financing. It's not the only factor, of course, but it's a major piece of the puzzle. High growth rate, more equity. Another important piece of the puzzle. Scene script. Profitability, a key determinant in deciding a company's capital structure. Now, let's dive into the world of profitability and its role in shaping the capital structure of a company. Simply put, profitability is the ability of a company to earn a profit. But how does this impact the capital structure? To understand this, we need to first grasp the concept of debt servicing. Debt servicing is the process of making regular payments on the principal and interest of a loan. Companies with higher profitability have higher earnings, and these earnings can be used to service their debt. Hence, it is generally observed that profitable companies tend to finance their operations with more debt. Why, you ask? It's because they have the confidence of being able to pay back the borrowed money with their earnings. Think of it this way. If you are earning a handsome salary, you might be more inclined to take out a mortgage to buy a house because you know you can handle the monthly payments. It's a similar scenario for companies. They leverage their profitability to take on more debt, which can be used for various purposes like expansion, research and development, or even to weather a financial storm. However, it's not as simple as it sounds. While profitable companies can afford more debt, they also need to consider the cost of debt. This is the interest that they have to pay on the borrowed money. If the cost of debt is high, it might eat into their profits, making the debt less attractive. Moreover, profitability is not a constant factor. Market conditions can change, and with it, the profitability of a company. So while a company might be profitable today, it may not be the case tomorrow. Hence, companies need to balance their debt and equity based on their current profitability and future projections. In summary, profitability plays a significant role in deciding a company's capital structure. More profitable companies have the luxury of taking on more debt as they have the earnings to service this debt. However, they also need to consider the cost of debt and the unpredictability of future profitability. Profitable companies can afford more debt. Makes sense, doesn't it? Last but not least, let's talk about market conditions. Market conditions are like the weather. They're unpredictable, often fickle, and can have a significant impact on a company's capital structure. Just as a sailor adjusts the sails to suit the winds, a prudent company adjusts its capital structure to align with the prevailing market conditions. Let's break this down. In a bull market, when stock prices are rising and investor confidence is high, companies have a golden opportunity to raise capital by issuing more equity. Why? Simply because investors are in a buying mood and are willing to pay higher prices for stocks. This makes equity a cheaper and more attractive source of capital. Not to mention, issuing more equity instead of debt can help companies reduce their financial risk. Now let's consider the flip side. In a bear market, when investor confidence is low and stock prices are falling, companies might find it harder to sell their stocks at favorable prices. In such situations, debt can often become a more attractive option. By borrowing money, companies can continue to finance their operations and investments without diluting their existing shareholders' stake. But of course, resorting to more debt comes with its own set of risks. Companies must be mindful of their ability to service this debt, especially in an economic downturn. A high level of debt can increase the financial risk and potentially lead to bankruptcy if not managed carefully. So, you see, market conditions can be a double-edged sword. They can present opportunities for companies to optimize their capital structure, but they can also pose challenges that require careful navigation. In essence, market conditions can influence a company's decision on whether to lean more towards equity or debt. This decision is not made in isolation, but is a strategic response to the ever-changing market landscape. Market conditions can sway the balance between debt and equity, and that's the crux of it. Understanding how market conditions play into the capital structure equation can provide valuable insights for both companies and investors alike. We've covered a lot of ground today. Let's do a quick recap. We've explored the intricate world of capital structure, shedding light on the key factors that influence it. We started with business risk, discussing how it influences a company's capital structure decisions. A higher business risk often pushes companies toward less debt, while lower risk may allow for more. Next, we delved into the company's growth rate. Rapidly growing companies typically rely more on equity financing, while companies with slower growth rates might lean more towards debt. Then, we tackled the subject of profitability. More profitable companies are usually more comfortable taking on debt due to their ability to service it. Finally, we touched on market conditions. In favorable conditions, companies may opt for equity financing, whereas in less favorable times, debt might be the safer option. Understanding these factors can help you make better financial decisions. Remember, knowledge is power,